Hey everyone, welcome back to the channel, your number one source for income-oriented investing. It's time for the first income landscape overview of the US stock market in 2025. So let's first of all see how the market's done in the last month, and then we'll go over some of the top covered call ETFs or high yield income funds on the US stock market. So if you look at the S&P 500 in the last month, not really that great, right? Minus 3.71%. So the market has been dipping a little bit recently. And by the way, just for reference, I'm filming this on January the 12th on the Sunday. The NDX or the NASDAQ 100 down 3.55%. The Russell 2000 even more, minus 7.28%. Bitcoin not so bad, just under 95,000 right now. So let's go over the high yield funds, everyone. Of course, we're going to focus really a lot on the index based ones, which I feel are really the best ones for your the foundation of your portfolio. So we'll do the S&P 500 ones first, then the NASDAQ 100 and the Russell 2000 and the more niche stuff. But first, I'd like to take a moment to thank the sponsor and good friend of the channel, Curve ETFs. Don't forget, guys, that they have quite a few single stock covered call ETFs that are in competition with YieldMax. You could always do the total return comparisons with the YieldMax equivalent ones. These guys are more focused on total return than yield. They have an Amazon one, Apple one, Microsoft, Google, Netflix, and they also have a KQQQ, which might be a good idea now if tech is really going to dip. So this one has some yield. It's not really an income-oriented product. It's more like a growth with defense on technology stocks. In case you missed it, I do have a Q&A with Howard, the CEO of Curve, to talk about KQQQ. So moving on, let's go through the most popular S&P 500 ones first. Of course, we're going to start with JEPI, the most popular one. And of course, the latest distribution, 39 cents, pretty much in line with the other ones. And you're always going to look at a 7 to 8% yield on this one, everyone. You have Bali, which is its competition. So first we're going to cover, by the way, the stocks in the S&P 500. So JEPI, Bali, and this one here is based on the S&P 500 index, but it's not exactly the S&P 500 index. It's stock picking, especially JEPI and Bali. So this is large cap, doing really well. Same type of yield that JEPI is going to have, except as we'll see in a second, the performance is much better. You're going to expect variance in distribution rates, but if you scroll down, you'll see that the general distribution rate is very close to what JEPI gives. So you're looking at about 7-8%. Then of course, if you feel like having an equal weight instead of a market cap weighted, you have RSPA from Invesco, which the yield is pretty high. You're looking at about 9% if you're interested in that. Now moving on to the actual 100% S&P 500 index-based funds, the ones that are, they're not stock picking or different, but they're entirely the S&P 500. You got your basic option, GPIX, which continues to do well. We'll check out the total returns in a second here, guys, but the distributions have remained very, very steady on this one, even increasing over time. So GPIX, if you really want the classic S&P 500 market cap weighted with covered calls, GPIX is a great basic foundational option. You also have SPY from Neos, of course, which gives you a solid 1% yield a month. So it's always about 1% a month, 12% a year. So if you want that, also want that consistent dividend like GPIX, but you want a little bit higher yield, SPY could be a good one. Then you have the rinse and repeat lowest fee covered call S&P 500 covered call ETF from BlackRock, from iShares. It's IVVW. All they do is a 1% out of the money covered call every month. The yield is definitely going to be higher on this one, right? Because you are giving up a lot of upside. So if you do the total return comparison between the 5 top ones, or the the 5 most popular ones, I guess, IVVW is the only one that hasn't been out for a year yet, unfortunately, but you see that GPIX and Bali are the clear winners here. Bali is actually the top performing one if we look at the last year of total return. But very interesting enough, you see that IVVW is actually doing the best in the last 3 months, and this makes complete sense because IVVW probably gives up the most upside, So when the stock market is flat or down, IVVW is going to do really good. And you actually see that last 3 months, it's actually beating everyone here. But unfortunately, no 1-year data yet. So moving on to the daily option, S&P 500 covered call ETFs, you have WDTE, used to be called JEPI with a Y. This one has a weekly dividend. So very, very high weekly dividend for this one here. You have SPY-T, which I feel is a little bit better strategy. You're looking at a target yield of 20% annually. But this is still monthly dividend, but a very consistent dividend, which is always going to equate to approximately 20% yield. Then, of course, you have XDTE, which has weekly dividends, but they could vary greatly every single month here. Latest one, 18 cents. The latest ones are a little bit higher with that volatility. You could expect big variance in the distribution rate. Then you have the ProShares one, which is the lowest fee daily S&P 500. S&P 500 covered call ETF from ProShares. It's iSpy. This one as well, you could expect a yield that varies greatly. Could be 8, 9, 10%, sometimes more. But as you could see, if you scroll down and look at the distributions, they vary greatly. Not that greatly, but they're not really consistent month to month. And then you have the new kid on the block, T-Spy, which is actually doing really, really well in terms of total return. It's actually the same MER as SPY-I. So T-Spy is a new kid on the block. If you want to check out the video, check out this video here, but it does basically daily covered calls. It uses technology, it says, to figure out the strike prices. You're looking at a fairly consistent dividend, by the way. It's been out for 4 or 5 months now. You're looking at, pretty consistent monthly dividends that equate to about 14% yield here. So that's a really good one. So in terms of total return, T-Spy and XDTE are actually the top ones in the daily ones. I think T-Spy actually took a little edge on XDTE in terms of total return. So definitely got to keep our eye on T-Spy here. And I believe they're actually going to come out with the NASDAQ and Russell 2000 one. So, hey, maybe T-Spy or Tap Alpha figured out the best strategy in terms of mixing yield and covered calls with total return. But we'll have to wait and see. I'm not going to do a total return comparison for these ones because I think none of them have been out for a year, guys. So we could barely see anything. So as soon as these ones, I'll start doing it after a couple of months once the data comes out. Because, anything before 1 year is not really that informative. Moving on to NASDAQ 100 now, everyone. Of course, we have the OG QYLD, which continues to do that rinse and repeat strategy, which I've talked about a million times. So we're definitely not going to go into it every single time here. And you're still able to see, obviously, December, a lot more volatility. You could see that it's much, much bigger, right? They made a 3% premium, but of course, it's only going to give out. I gave out a little bit more. I don't know exactly why. Did they change their, and I'm just realizing this live, is it because they had to give out all the income because it's the final month of the year and they have to give out all their capital gains? I think so. We'll see next month, but normally they never give out more than 1%, as you could see the black dot, right? So I find that really strange. Let me just see the distribution history here real quick in 2024. Was it a massive? Yeah, it was a massive dividend. So I think this is just they had to give out their all the capital gains that they had. So that's why it was a lot more. So we'll see next month, but I assume it's going to go back to 1% max. You have JEPQ, of course, JEPI's NASDAQ brother. Distribution a little bit lower than last month, but with this one, you're going to expect about just 1 or 2% more than JEPI, I would say. So instead of 7 to 9, you're probably looking at 9 to 11 because the NASDAQ is a little bit more volatile. You have GPIC with a Q instead of an X for your basic Goldman Sachs option, which is very similar to JEPQ, but it's actually the NASDAQ 100, where JEPQ does some stock picking with the NASDAQ 100. You have QQQI from NEOS. This one's doing really, really good in terms of performance. It's relatively new. It's not even a year old yet, I believe, but consistent 13-14% yield here. Again, 1 or 2% more than SPY-I, right, than the S&P 500 equivalent one. And then, of course, you have QQA, which is the Invesco version, which is giving you about 10.5% yield. So if you do the comparison, some of them have been out for a year, so it's good to see. We see that JEPQ and GPIC in a dead heat, but they're both doing really well. They're at the top of the game. Unfortunately, QQQI hasn't been out for a year yet. But if we look at the 3-month, which doesn't really tell us that much, everyone, JEPQ has done the best, with QQQI in second place, doing pretty good as well. So hey, I think the NEOS one for the Nasdaq is working a little bit better total return wise than the S&P. It's always funny to see how some fund manager strategies just simply work best on different indexes. So with NEOS, it looks like definitely QQQI is really good, and even JP Morgan, really good. JEPQ is doing much better than JEPI, right? I think you're understanding my point here. Moving on to the daily, the funds that use daily options on the Nasdaq 100, you have QQQY, which is of course very, very, very high yield, weekly dividend. The QQQT, which I feel is better, targets 20%, just like SPY-T. And of course, you have my personal favorite, QDTE, which is still winning the total return war, and not that far behind as you have the ProShares one, the IQQQ. So again, none of these have been out for a year, just QQQY, and I believe QQQY is actually the worst performing one out of these four. But once we have more data, more total return data, I'll show you guys also the total return for the daily Nasdaq covered call ones as well. Finishing up with the Russell 2000 index, which everyone thinks that it's going to do really well because of interest rates going down and Trump taking office. But hey, I will say you should always think long term. Personally, I didn't go into the Russell 2000, but hey, it could be a good index. It's a good diversified index to add as a foundational core position in your portfolio. And we have a few of them here. You have IWMW, which is pretty much the same thing as IVVW from BlackRock, except it's on the Russell 2000 and it's 2% out of the money every month. Rinse and repeat. Big advantage with this one is a very low expense ratio as well. This one's going to have high yield, guys. Very, very high yield. Of course, it looks a lot higher because I think the latest distributions, the December distributions, were a lot higher than normal. This is, again, remember, many ETFs have no choice but to pay out all the capital gains in the fund before end of year. So that's why the December distributions could be a lot higher than normal. But you're still looking at a very high yield with this one. You have the NEOS equivalent one, which is just under 15% yield. So I'm curious to know after a few months, after a year, which one's doing best. But by far, in terms of total return war, RDT is beating everyone right now. So RDT is, of course, same strategy as QDT and XDT, but on the Russell 2000 index with weekly dividends. You also have IWMY, which has very high yield as well. Same thing as QQQY and WDT, but on the Russell 2000. So again, high, very, very high yield, but it seems to be in last place in terms of total return. Last but not least, you got the ProShares one, ITWO, which is the lowest fee daily option covered call ETF one, right at 55 basis points. And, just like the other ones, you're going to expect big variance in distribution rates. If you look at 2024, you see that, 66, 56, and 39. So a big variance. But the advantage with this one is it has the lowest fee out of all the daily option Russell 2000 covered call ETFs. We have, of course, a YMAX, the all-in-one of YieldMax, which is has a weekly dividend, which is going to vary based on volatility. You see that here. And in terms of YieldMax, did they add any new ETFs? I don't think they added any single stock new one. Their latest one, Palantir and Marathon. They did have the Target 12, a little bit more subdued, which I talked about with Jay on the channel. And they also have the Dorsey Wright ones that they added. This seems very interesting if the Dorsey Wright, basically what they're doing here with FEET is that they're choosing 5 stocks or 5 YieldMax single stock covered call ETFs that have the most momentum, and it's reset every month. So the 5 funds that they choose could be different every single month. It's reset. They're choosing the 5 that have really good performance and momentum. So it could be a good idea if you want, you always want to have the 5 that are the hot stocks of the month, basically. That's the way I see it. Right now, for example, it's Meta, MicroStrategy, Netflix, Coinbase, and Tesla, which have been very hot. But next month they could be, they kick one out and put another one back in. Whichever one are hot are in here. I expect fairly high dividends and yield on this one because you're always going to have fairly volatile stocks, I believe. So anyway, just wanted to point that out. I don't think a video is necessary, but that's what basically these Dorsey Wright ETFs are. It's really an index. And FIVI is just a hybrid approach, where they put the actual stocks themselves as a percentage with the yield max, right? So you have a little bit of growth in there, basically. So you see that they'll actually put in a percentage of the actual stock itself, Tesla, Netflix, MicroStrategy, Meta. But the bigger percentage, I believe it's going to be 60-40, right? 60 in the yield max ETFs and maybe 40% overall in the actual single stock. So this is basically a hybrid, and that's why it's actually called the Hybrid 5. If you want a little bit of growth in there, which the feat is full income. And last but not least, in terms of equity, the only one, as far as I know, that's has the whole world, right? If you're someone who, look, I don't want to pick just the S&P, the Nasdaq, the Russell, I want the whole world, that includes those. Well, you have GIAX, which is, by the way, under the title umbrella. And this one, if you scroll down, you'll see has a pretty consistent yield of about 23-24%. But if you look at what it has, that really tells you the story. S&P, Russell, U.S. dividend stocks, mid-cap, some Argentina, some India, emerging markets. So it's kind of, the whole world, and it uses daily options as well. So this could be an interesting one if you absolutely want the whole world, hence the name Global Equity. Moving on, finally, to the more niche stuff, you have SVOL, which I know, unfortunately, reduced its monthly distribution again from 27. It went from 28 to 27 to 26. But hey, even with 26 monthly dividend, the yield is still pretty high. It's in the 14-15% range. Got a little bit of fixed income in here. This is still my favorite option if you absolutely want fixed income. Instead of going for a pure fixed income thing like TLTW, which has been a disaster, I'd rather you go with SVOL. We have the Rex Shares one, which they have 3 sector-specific covered call ETF, mostly on tech. So you have FEPI on your more basic general tech companies, and you're looking at a pretty consistent 25% yield here. It's done really well, obviously, if technology companies do well. This is simply a technology covered call ETF. You have AIPI, which is going to have a little bit more stuff in AI. So a lot of the same stocks, but you'll have things like Palantir, make a bigger portion, CrowdStrike, ARM, so things that are more geared towards AI, but you'll still have the classic tech stocks like Broadcom, Apple, Qualcomm, Cisco, Nvidia, of course, et cetera, et cetera. So, of course, AI type stocks like Palantir, more volatile, which is why you'll get a little bit more yield. Then the new one, which is going to focus on crypto-related stocks. They haven't declared the first distribution yet. But if you look at what stocks they have, it's mostly still tech stocks that are in one way or another going to be involved in crypto. So you actually see Visa, MasterCard, Nvidia, Robinhood as well. MicroStrategy is there, but I guess it's lower on the list. I definitely thought it would be a much higher percentage. But hey, what are you going to do? And if you want pure Bitcoin, you have YBTC, which has recently changed their distribution rate to weekly. This is just Bitcoin with covered calls. And you have BTCI, which is the same thing, Bitcoin with covered calls. They're just writing covered calls on IBIT, I believe now. So if you look at the holdings, you see that they're actually writing covered calls on IBIT instead of BITO. So very high yield. If you want just basic Bitcoin with covered calls, these are your two. Or there's also Maxi, which just does call spreads on other things to give you exposure at Bitcoin to Bitcoin at the same time. So this one here, I believe also they had their final distribution for December, which is a bit weird. So we'll see next month. My assumption is maybe they'll bring it back to $1 a month. I'm not sure. So fairly high yield because Bitcoin has been pretty highly volatile as well. So these are your Bitcoin options. So that's pretty much it for the income landscape overview, everyone. So in terms of the S&P, NASDAQ ones, as they get older, I'll do more total return comparisons. So, once we have a year of data, I know you guys have given me feedback that you actually like that. You actually like looking at the total return comparisons. I'll do the same thing, for the Bitcoin ones as well, once they pass a year, and for the Russell ones as well. So again, remember everyone, I'm not covering every single high yield covered call ETF, but I'm really focusing more on the index ones, which I feel are the best, foundational for your portfolio. It's just a matter of choosing which one is best for you. There's a couple of good niche ones as well, like SVOL and FEPI and things like that, if you want more concentrated in a certain sector, or if you want something even more boring than the S&P 500, which in my opinion is SVOL, right? If you're a little bit more of a conservative investor. So appreciate you taking the time. Please hit that like button. I would really, really appreciate it. And we're going to do this again next month. So see you next time.